This is a super question. And you're asking, can I speak on options for home repairs, such as loan types and the differences? Yes. So if you already own the home and you need to do repairs, whether it's your primary residence or a second home or even a rental property, there are several different loan types that you can choose from. The first loan type that you can choose from is going to be a home equity line of credit. A home equity line of credit is a revolving account. You have access to use it for, let's say, 10 years, and you have an additional 15 years to pay it off after you use it. So during the first 10 years, you are only billed the minimum interest on what you have withdrawn. Say, for example, your home equity line of credit has a limit of 75,000, but you say, hey, I only need 10,000. I'm just trying to fix the kitchen. And once you use that amount and you've withdrawn it, you can go ahead and pay either just the interest during the first 10 years, or you can pay as much as you need to or want to back towards the principal. Now, that's the first option. You can always use and reuse that account for the drawing period. So the particular bank I work for, the draw period is 10 years. Then other banks like credit unions, they have a draw period of 15 years. So you can continuously reuse it and reuse it. Now, that's a home equity line of credit. The rate with that is variable. That means the rate can adjust. That means the rate is tied to the prime rate, just like the Federal Reserve just met this past week and discussed the interest rates. If they decide to increase or decrease, your rate will also follow depending on your credit, depending on the value of the property and the line amount that you choose. That's a home equity line of credit. Then there is a home equity loan. A home equity loan, you receive the money as a lump sum, have to pay principal and interest, and you have to have it all paid back within like a 10-year period. That is a home equity loan. The rate is fixed, the payment is fixed, but you get it as a lump sum and you have to make equal payment amounts for the 10 years to pay it off. The third option is if you need to do, let's say, a personal loan, which is not attached to the house, it is just attached to your name and your credit score. The interest rates are typically higher on personal loans because there is no collateral holding that loan in place. They are just using your name and social. So therefore, if you were to default or something like that, the worst that'll happen is they're going to put it on your credit report and then try to come after you in a civil matter. If this is for a property that you have not purchased, some banks, sell rehab loans to where you can get the money to purchase and get the money to fix it up. If your credit is strong, you can definitely go to a bank or a credit union. If your credit is not as strong, then you can certainly take a look at a mortgage broker who's going to pretty much shop around to find who is going to have the best rate. There are going to be some higher fees associated with a mortgage broker. So hopefully that answers your question. If you have any more questions, let me know.